Let's get right to today's action. We have Ryan Dietrich, Schaefer's Investment Research Senior Technical Analyst. He says it's time to pay attention to the areas of the market where there is a lot of negativity. Maybe that's where we should be going. Tom Lydon, ETFtrends.com editor and Global Trend Investment President, says rising rates, sluggish growth mean it's time to look overseas for yield. We have a debate on emerging markets in particular from these guys. And Scott Shellady is joining us from the pits of the CME. Scott, I want to start with you. We mentioned biotech. You say biotech is kind of a smokescreen for what?
Well, I think that if you take a look at the Citigroup Economic Surprise Index, it's showing that we're missing analysts' expectations more and more as of late. Then I went to Asia and look at that. I looked at the same index there, and I looked at the European one. There's weakness all over the place. And the last time I remember biotech's leading us higher, never. So you can't say they're leading us lower if they don't ever really lead us higher. I think it's a smokescreen to hide behind. At the end of the day, we're not seeing the growth we need. The GDP number at the end of this week is going to be huge.
Wow. You know, Ryan, you're pretty bullish about the market overall, but even you were saying that there's a lot of skepticism out there. Fair enough, but that skepticism could translate into more days that we've seen like today.
Well, that's right, Cheryl. When you get down to it, last 40 years, the last week or so of March actually is very volatile and choppy. So, it's strong into that, and then you get that choppiness. But what you need to look forward to, the last 5 years, April's the second strongest month. The last 10 and 20 years, April is hands down the strongest month. So once again, seasonality looks good. Talk about overall investor sentiment. Yeah, people are a little more optimistic, but all of a sudden we're getting that shakeout like we just talked about. Biotech, small caps, definitely getting a hit. People are getting, once again, pretty fearful. Doesn't mean this dip can't continue, but overall, I still think, consolidation here and then a higher April looks good to me.
All right. By the way, Ryan, Tom is big on emerging markets, and I think you two are going to have a fight on that one. But before we go through that, Tom, I want to ask about the earnings reports because, we've seen a kind of okay earnings season in this last one, but the next one we're going to be dealing with the bad weather that we've had this winter, some other things. Are we looking forward to a bad earnings season coming up?
Well, as you point out, 65% of the stocks in the S&P 500 beat, David, in Q4. 7-to-1 negative pre-announcements to positive pre-announcements in Q1 in 2014. That's a concern. Emerging market, China, problems over there as well as we've seen devalued currency. And then the whole thing about Crimea, and finally, the winter effect. Nobody knows how that's going to affect earnings. So, although from a seasonality standpoint, I'm with Ryan. I think, trends are in the right place. But it's all going to be in the numbers when we get into April and start seeing what those numbers really bring.
You're not with Ryan on emerging markets, but go ahead, Cheryl.
No. Yeah, I actually want to go back to Scott on what he was just bringing up, what Tom was talking about with the situation in the Ukraine, because certainly the situation has gotten a lot more serious than many of you down on the floor, I think, had initially predicted. How are you feeling now?
Well, the seriousness of it, I think, is something we need to take a look at. But ultimately, at the end of the day, let's just say that there are warplanes and then bullets are shot. I think ultimately it still comes back to the U.S. data. Yes, we will have a knee-jerk reaction on something that escalates over there. But at the end of the day, it's going to be how the numbers come out here. And that's really what's important because they haven't been good. We keep talking about what we'd like to see happen. Janet Yellen said that last week, but we're not seeing the numbers come through yet.
All right, Ryan, I'm going to set up the debate here. With all that is going on in emerging markets, Tom is still pushing for it. Why do you think emerging markets are probably the worst place to put your money right now?
Sure. Well, one important thing when you talk about emerging markets, there are other areas. India's been doing well, for instance, for a while now. Brazil's been doing poorly. So when we say emerging markets, we kind of lump them together. So you do have to dissect it a little closer. But, bigger picture, the EEM, the big emerging markets ETF, that's what we all talk about. Now, let's focus on that for a second. That thing, we follow option activity. A lot of calls continue to come in on it. It's been underperforming for a while. Again, there was Merrill Lynch Bank of America Merrill Lynch just had a big hedge fund survey come out last week. What's the most undervalued area that people just love, hands down? It's emerging markets. From that contrarian point of view, something that's been going lower, people continue to try and pick a bottom. To us, it's not something you want to be in specifically, maybe slice and dice and find certain areas you like. Overall, emerging markets, we'd still avoid them here.
Tom is back. Tom, we have been dumping all over emerging markets. Unfortunately, you can't be specific about our criticism of them, but why do you defend them at this moment when there's so much craziness going on around the world?
Well, you're right, David. But again, we're looking at the Fed tapering rates. Everyone's playing this game of trying to estimate when this is going to happen. In the meantime, over in emerging markets, if you look at emerging market debt, a couple things. Their balance sheets are much better than developed markets across the world, number one. Number two, as far as their paper, sovereign debt, it's paying a great premium to what we can get here in the States, and in most cases with these emerging markets being in favorable monetary policy mode, and in early stages of recovery or while they're declining, you get paid to wait while they come back. And in some instances,
hold on a second.
as in this iShares emerging market bond,
isn't the question if they come back in some of these cases?
Well, right. Well, it's much better to buy when it's low, correct? And here in the U.S., we've had a pretty good run, both on the fixed income side and the equity side. I just think, especially retirees, looking to diversify income opportunities, great opportunities with emerging market debt ETFs, and especially global bond ETFs where default rates overseas are much lower than they are here in the U.S. It's all about choice and diversification. If you get paid for it, why not?
Tom Lydon, good stuff, Tom. Thank you very much. Ryan Dietrich. Tom was worth waiting for, wasn't he?
Tom had a TV moment today. Yeah, welcome
it
to the
happens
club.
to us all, Tom.
Thanks for putting up with me.
Thank you for being patient with us. We appreciate it.